Thank you for your kind words of introduction. Thank you, Tally, for giving me an opportunity to share my views on the UAE corporate tax on the management remuneration aspect. And now I will start the presentation. The management remuneration, paragraph 7.5 and 7.6 of the public consultation document was very clear that in case of in absence of the personal income taxation in the UAE can generate incentive for individual owners of taxable business to erode the UAE corporate tax base by making excessive payment to themselves and person connected with them. So FTA or authorities are very, very clear that So FTA and authorities are very, very clear that they are going to look into this aspect of payment to owners and payment to connected person or related parties in a very, very strict manner. And that is why we need to look these provisions in a very, very strict manner. Management remuneration, it can be classified into the three aspects. So either the shareholder is a management, or management can be with the related party of the owners, or management of the company can be with the independent party. So let us see what happens when the shareholder is the management. Okay. Now, Article 33 of the proposed CT law, it is saying that there are certain non-deductible expenditure which will be there. Okay, and that expenditure, one of them is very, very 0.4, that dividend, profit distribution, or benefit of a similar nature paid to an owner of the taxable person. Dividend we all understand, profit distribution we all understand. Now the cases of the benefits of a similar nature paid to an owner of the taxable person. So here, one thing which needs to be taken into account is that benefits in the nature of appropriation of profit, if it is paid to an owner, then it will be disallowed as per Article 33. Secondly, if no functions are performed by owner, then management remuneration payable or paid and debited to profit and loss account of the company, then that will also be disallowed. Payment for the entrepreneurial risk which is undertaken by owner, then that is also disallowed. Method of accounting will not be a deciding factor as far as allowability of the expenditure is concerned. So benefits of a similar nature paid to an owner is a very wide term in my opinion. It is not defined. It will need to be interpreted. But as I understand that benefit in the nature of appropriation of profit paid to owner will be disallowed as a business expenditure. Now we have certain points to ponder that we all know in this part of the world, when bankers analyze the balance sheet and profitability of the company, they usually add back the management fee and management remuneration paid to the owner while analyzing the profitability of the company. And in past, when there was a 51-49 shareholder, now many LLC company, you can have a 100% shareholder as well. So there, to safeguard as a interest or to restrict the profitability so that the dividend payable to the UAE national partner is approximately 20% of the profit of the company. So balance amount was usually taken by way of a management fee or management remuneration or incentive. Similarly, remuneration was being paid on account of director guarantees to the bank on behalf of the corporate. This will also be taken as a benefit of similar nature paid to an owner of the taxable person. Now, let me come to management of a related party. Owner we have considered, and there are 3 articles in the law which says Article 34, Article 35, Article 36. Now first we will take up Article 35 because we should know what are the related party as defined in the law. So in this decree law, Article 35 says the related party means any of the following. And they said if it is 2 and more natural person, then who are related within the 4th degree of kinship or affiliation. So this is very, very big thing. If you see on this slide, we have to start with the self and the spouse of the owner, and we have to go 4 steps up, 4 steps down, like parents, grandparents, great-grandparents, great-great-grandparents. And below it will be child, grandchild, great-grandchild, and great-great-grandchild. Similarly, we need to take uncle and aunt, grand uncle and aunt, great grand uncle and aunt, brother, sister. All these are covered by way of related party. So now, along with a trade license, as we are saying that you will need to have a family tree. And suppose there are 3 shareholders, major shareholder, equal shareholders. So you need to prepare this chart for all the 3 shareholders and their spouses. So there will be 6 such chart needs to be prepared to be very clear that who are the related party of the company or the organization. So it is a very big thing which needs to be documented, which needs to be very clear. Regarding related party between the natural person and a company, so there the 2 major criteria are there: 50% of or greater ownership interest, or you control another company. What defines control? We will just take in 2 more after next this. And if two or more corporate are related, if once again ownership criteria 50% or more ownership interest, or you control another company. Another one is permanent establishment, person and its permanent establishment, or 2 or more person are partners in the same unincorporated partnership, or person who is a trustee, founder, settler, or beneficiary of a trust or a foundation and its related party. So friends, you will be able to visualize the definition of the related party is very, very wide, and we need to be very clear who are the related parties of the organization, and accordingly we need to see and document. Now comes the control, because we said between the natural person and a corporate, control is also one of the factors to be considered. And Article 35 once again defines that control means ability of a person, whether in their own right or by an agreement or otherwise, to influence another person. And this, they are saying, some of the factors which they have accepted is 50% or more of the voting right of the investee company or their another company, we have ability to determine the composition of 50% or more of the board of director of another company, or ability to receive 50% or more of the profits of the another person, irrespective of your shareholdings, and ability to exercise significant influence over the conduct of the business or affairs of the another person. So here significant influence is not defined in the law. I have taken the significant influence from International Accounting Standard 38, where it is significant influence is defined is a power to participate in the financial and operating policy decision of the investee, but it is not a control or joint control of these policies. Second, if you are owner of 20% or more of the voting right, it is assumed that you have a significant influence. Unless you can prove otherwise that in spite of my holding 25% of the shareholding, I do not have a significant influence. So this is how the control has been defined in the law. Now, what are the payment to connected person? So what is the connected person? So connected person in the law is, they have said, owner of the taxable person, director or officer of a taxable person, and related party of any of the owner, director or officer. So once again, we will have to prepare that family tree of the same person, of the director as well as the officer of the company. Here, owner we know, director we know, officer is at one term which is not defined in the law. So officer means a corporate officer or high-level management executive which are hired by the business owner or board of director, and which can include chief executive officer, chief financial officer, president, vice president, or if the company is having various verticals, so that division heads, vertical head, everything will be covered as a connected person. Now, Article 36, which controls the payment to connected person, and that is saying that any payment to connected person will be deductible only if and to the extent that the payment for the benefit corresponds with the market value of the service or benefit provided by the connected person. And second condition is, this is incurred wholly and exclusively for the purpose of taxable person business. So here two things are very, very important, that we need to establish what services or benefit company has got for the payment done to connected person. That is first. Second, services are received for carrying on the business activity only, and the market value, the amount which you have paid, needs to be at arm's length price, which we will just take up, or market value only will be allowed. You have paid 2 million to connected person, but the market value or arm's length price of that services is only 1 million, in which case 1 million will be disallowed as expenditure while computing the taxable income of the company. And last but not the least, this expenditure needs to be incurred wholly and exclusively for the purposes of taxable person business. That linkage needs to be proved, needs to be established. Then only you will be allowed to take the deduction for this kind of payment. Now, we need to come, what are the taxable income, arm's length principle. So arm's length principle is defined in Article 34 of the law, which says that in determining the taxable income, transaction or an arrangement between related parties must be meet the arm's length standard. And what do you mean by arm's length? That if the result of the transaction or arrangement are same or consistent with the result that would have been realized if the person who were not related parties had engaged in a similar transaction or arrangement under similar circumstances. So circumstances, facts, scenarios, everything needs to be same, in which case what I would, as the owner of the business, I would have paid to that third party. So whether I am paying the same amount to this by related party or my connected person, this needs to be established. By whom? By the business person or the SSE, taxable person. As per the OECD guidelines, there are 5 methods which you can take. Of course, comparable uncontrolled price method, resale price method, cost plus method, transaction net margin method, and transaction profit split method. These are the 5 methods which OECD has already prescribed. There are, so that either of these 5 methodology we can follow to determine the arm's length price. One more factor or one more principle which they are saying is the taxable person can demonstrate that any of the above 5 methods does not give the correct result of arm's length price, then you can have balance residually method or any other method which can reasonably applied to determine the arm's length price result. Friends, when we come to management remuneration, an amount which is payable to the directors or connected persons, usually we will have a very difficult time in benchmarking this transactions, and therefore 6th method which will be put to use is any other method. Further, the law itself specified that the choice and while taking or applying any method to arrive at the arm's length price, what you should take into consideration. So there are the 5 things which they have said. One is the contractual terms with the transaction of the transaction or an arrangement. So there has to be a contract. Characteristics of the transaction or arrangement, economic circumstances in which the transaction or arrangement is conducted. This is also very important, economic circumstances. This is the heart of any transfer pricing analysis. What are the functions performed? What are the assets employed? And risk assumed by related party while entering into the transaction or an arrangement. This needs to be properly documented, analyzed, then only we will come to a correct arm's length price. And business strategies employed by the related parties entering into the transaction or an arrangement. All these 5 factors we need to keep in mind while analyzing or coming to the conclusion for the arm's length price documentation. Friends, Article 20, Subclause 2, Subclause E requires adjustment for the transaction with RP and connected person while computing the taxable income. That is, if you look at that article, what it says, you start with the profit as per your profit and loss account, then add back whatever the value of the transactions which you have done with your related party or connected person, and then that will be the price at which they are recorded in books of account, and then you deduct once again. So you are increasing your taxable income base, then deduction of these transactions will be allowed at the arm's length price. So whatever price you have recorded, we will disregard. Whatever arm's length price of all these transactions will be allowed as a deduction while computing the business income. One more important thing which you should be aware, that if any result of transaction or arrangement that does not fall within the arm's length range, it is not a fix, it can be within the range, in which case the authority will be adjusting the taxable income to arrive at the arm's length result that best reflect the facts and circumstances of transaction and arrangement. So authority can make adjustment that you claim that arm's length price is 1 million. However, in our opinion and based on various facts and circumstances, arm's length price of this transaction or this services provided by the directors or a connected person cannot exceed, say for example, 400,000. In which case they will once again add back 600,000 to your taxable income while computing the taxation. But one more thing, section article 34 subclause 9 is very, very important, which says that where authority makes such an adjustment to taxable income pursuant to clause 8 of this article, the authorities rely on the information that can or will be made available to the taxable person. So, in the international transfer pricing parlance, any secret adjustment, that means based on the information or facts which are only available with transfer pricing officer, they cannot suo moto add that we will add this, your transfer arm's length price computed by you is very high. It should be like in my example, 1 million you have said. In my opinion, it is only 400,000. Now, on what basis he is coming to the 400,000, he will have to give the information. In certain part of the world, this suo moto adjustment or secret adjustment in arm's length prices is being done. And of course, it will result into the litigation. But here the law is very clear that whatever adjustment an authority make, they have to give information to the available person or taxable person. Now, transfer pricing documentation. Article 55 gives you the what documentation you are required to be kept for the purpose of transfer pricing documentation. They say, first of all, you need to file along with your tax return a disclosure containing information regarding the taxable person transaction and arrangement with its related party and connected person. So what are my transactions with related party and connected persons? All needs information. A form will be prescribed by the authority, and in that form we need to give all this along with the value to the assessing officer or the federal tax authority while filing our taxable income. Second, they are saying that taxable person needs to maintain a master file and local file in the form, which are usually very well in the OECD guidelines. So we can take it from there as well. Second, this master file and local file need not be submitted along with your taxable return which you are filing. Only information regarding the transaction or arrangement with RP and connected person is required to be informed to them. The filing of master file or local file is not required to be done along with the income tax return to be filed. Then when an authority asks for such an information, then within 30 days of the request, we need to provide this master file and local file to the authority. Secondly, upon the request made by authority, the assessee, taxable person, assessee should provide with the authority any information to support how you have calculated the arm's length price, how you have come to a conclusion, which method you have used. 5 methods we said, 6 is the any other method. So which method you have followed, how you have computed, how benchmarking of the transaction has been done. All this documentation needs to be filed with authority within 30 days of the request made by authority. Friends, you all will know and appreciate that as per the law, 7 years, the assessment period or records needs to be maintained by SSE for the period of 7 years. So that means we are in 23. 7 years means up to 2030, you will have to maintain the record. And the transaction in 2028, after 5 years, the authority will ask, please give me information to support your arm's length price calculation. So at that point of time, we cannot, and this all information you have to give within 30 days. So at that point of time, to get various benchmarking data available on the various software, etc., may not be available. So we need to prepare the documentation, all that thing, even though this is not required to be submitted at the time of filing the tax return. All this information needs to be prepared, properly documented, and needs to be kept ready as and when the transactions are happening, or at least before the income tax return is filed within the 9 months of the end of the accounting year. So this documentation is very, very important. One more thing is public consultation document, say paragraph 7.12, that where certain threshold may be prescribed by the authority, that if you don't exceed certain threshold of the related party threshold with the value, any value prescribed by the authority, if you don't exceed that threshold, you will be not required to maintain master file or local file documentation as we discussed. However, please note that arm's length value of the related party transactions will be required to be maintained. So how you have computed arm's length price, that documentation is required to be maintained and prepared first only. So even though your threshold, like in Saudi, the threshold is 6 million Saudi riyal, and this includes all your RP transactions, including the payment to like sale to related party, purchase from related party, management remuneration, etc., etc. So all this should be added while computing the threshold. And secondly, while computing this threshold, arm's length value will be taken into consideration and not the value at which the transactions are recorded in your books of accounts. This gives that is there any regulation in UAE which provides a guidance on managerial remuneration? So now we all have discussed that we need to benchmark that it is at arm's length. So whatever the services are provided by my director or connected person or my division head, CEO, CFO, how I need to say that they are at an arm's length price. So is there any regulation in UAE which provides any guidance on this? Friends, we have one regulation which is UAE Federal Law number 32 of 2021 on commercial companies, which says that in case of a public joint stock company, the remuneration of board of directors, only to board of directors, total remuneration to board of directors will not exceed 10% of the net profit. Okay, 10% of the net profit. This is the limit prescribed by Article 171 of the Commercial Company Law. So anything in excess will be violation, will needs to be reported by auditor concern. And they have gone one step further, that if there is a loss, in which case each member may be paid a lump sum of 200,000 dirhams. In case of loss, failure to achieve profit, that means in case of a loss, individual member of board of director cannot be paid in excess of AED 200,000. Question arises whether this provision will apply to the limited liability companies. Article 104 of the law, commercial company law, specifically mentioned that for all that is not specifically provided in this decree law, that is commercial company law, the provision concerning the joint stock companies shall apply to the limited liability companies. Unless the Council of Ministers gives by way of circular that all this provision, even though applicable to the joint stock company, will not apply to the limited liability companies. So that we need to keep in mind while computing this. Friends, there are another 2 slides, but for the time constraint, I would like to just rush through. We need to maintain comprehensive documentation of key experience of the person, detailed career profile, company's operation during the year, roles and responsibility of the connected person, size and area of operation of the company, performance of the company, performance of the industry, internal policies which are coming from HR or remuneration committee of the company. And all this would show that concerned person did not anyway influence his remuneration, and appropriately signed agreement between the director or the person and the company should be made, and it should minimum cover role and responsibility, remuneration which can be fixed and variable, procedural and administrative action of non-performance of duty, and in scenario of loss during the financial, what will be the remuneration. All this will be undertaken, which will substantiate that such payment is commensurate, keeping in view the benefit obtained by the company. As we may seen that Article 36 mentioned that unless this benefit is obtained by the company of the function performed by the related party and owner, director or officer of the company, and the value is the market value, we will not be allowed any deduction for payment made to them. So this kind of documentation will be required to be presented. Thank you very much for giving me an opportunity to share my views on the subject.